Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Tonight, we are running through an introduction to the Williams Real Estate Investment Strategy. This is an introduction and a summary, high level of our strategy and what we go through in a detail 2-hour session prior to buying any investment property. We run through this in further details, but I thought I'd give a high-level summary so people are more aware of our strategy and how we sit in the market and how we look to build that solid residential foundation portfolio that will last you and your family a lifetime. So without further ado, let's kick off a couple of these slides. We start with understanding firstly, what is the end goal in mind? Is to create that passive income through two ways. This can either be through the rental income, so you can buy your 10 property portfolio, let the rent pay off the debt over a 20, 30-year period, and then you'll have that unencumbered investment portfolio bringing in rental income every day of the week. That can take 25, 30 years for the rent to pay off the debt. So that is more of a conservative approach. How I also like to use the portfolio is by releasing the equity. So a combination of using the rental income as a passive income, but also the equity release strategy, which is where you refinance your properties every 6 to 12 months, increase your loans, cash out the equity to not only reinvest into future assets, but also enjoy the fruits of your labor. Really only after 3 to 5 years of investing, you'll be able to enjoy the equity growth as we target markets that are primed for their next growth run, which will provide you that accessibility to the equity to not only reinvest, but also to park a solid cash buffer, but then also tap into that equity, because typically property has a compound capital growth of 7 to 8% on average per year. In the booms, 20 to 25%, and in the slowdowns, 2 to 3, 4%, but on average, 7 to 8% per year. So if you can build a portfolio that's worth 3 to 5 million, that's compounding at 7 to 8% a year, that's a few $100,000 every year. And if you're only tapping into 1% of that, being 50, 60, 70 grand, then it's very manageable with the higher rents to service the increased loan amounts. And you may be thinking, well, Geordie, am I just going to be taking on more debt? Yes, that is the case. You'll be taking on more debt. However, this is by no means financial advice. You have to talk to your financial advisor and your tax accountant. However, when you draw equity out of a portfolio, that is a non-taxable event. You don't get taxed on drawing equity as it's debt. Yes, you'll pay at today's rate 6 to 7% interest to the bank, but that is a lot cheaper than paying up to 45% to the ATO. So that is how the large property investors get ahead and use the equity out of their portfolios to supplement their lifestyle, to use that as a passive income. That is a strategy. It's very powerful, and it only takes a solid 3 to 5 years of investing to get yourself into a position where you can start laying back, taking a few months off work, working part-time, as you'll be able to access that equity relatively quickly. So that's the ultimate end goal in mind, is to create that passive income. How we do it, and this is what we do, we buy the blue-collar, working-class, fundamental, affordable housing. We like to stick to residential to build that solid residential foundation base. We start by firstly buying units in the metro markets or villas, townhouses in the likes of Sydney, Melbourne, Brisbane. Once you're into those markets, you have good growth, provided you buy the right product at the right time for the right price point. We're buying many units, townhouses, villas in Brisbane for 150 grand, 160 grand, 200 grand. 5 years ago, now they're all worth 400 to 450 plus. So when you hear the people say, don't buy units, they don't have capital growth, they don't know what they're talking about, is the reality. The biggest investor in the game, Harry Triguboff, specializes in only apartments. He started with a modest block of 4. and then he went from blocks of 4s to 6s, 8s, 10s, 20s, 100s. These days, he's building high-rise apartments of 1,000 units in each complex. They definitely work. It is the most stable, fundamental asset class. If the biggest guy in the industry in Australia specializes in that product, that's a pretty good blueprint to follow. Not only Harry Triggerboff, but also Donald Trump and the Trump organization in the US. Frank Trump, Donald Trump's father, started the business, the Trump organization, back in the 50s and 60s by building houses, then moved into building blocks of apartments for the government over in Brooklands and in Queens. Trump then took it to the next level in New York and started building high-rise apartments, high-end stuff. They then diversified their portfolio into casinos, golf courses, and put their name on pretty much everything. When the 91 downturn hit, Trump had to offload most of his commercial assets, including his casinos. They weren't bringing in money. And what got him through that tough time was his core business, which was the affordable housing rental properties, which were all units. They call them condos in the US. So units definitely work. They work on a large scale and also good to when you're starting off. So that's why we like to start off with units, because when you're getting into units in the metros, you can get 2 or 3 of them rather than soaking up all your capital into one house. And there'd be like 99% of people and get stuck at 1 or 2 properties. You need to preserve your capital. It's a game of finance. And this is the best strategy that I've developed that will get you to 10 properties within that 10-year window, and you don't need big bucks to start. So that's why we start with units in the metros or villas, townhouses. Once you've built up the equity, you can leverage the equity to buy into more, then leverage into the regions, into buying houses on large parcels of land that have development upside, so you can build a modest granny flat or subdivide it into to build a second house, or knock the thing down and build a block of 3 or 4 units. Not straight away. Typically, developers buy sites, sit on them between 5 to 10 years until they are feasible, till they stack up to develop. Then they will go and develop it. So I don't suggest going and developing stuff straight away, especially in a market like we are now. Nothing really stacks up. You need to sit on it, hold it through a market cycle. Then if you are looking to be a bit more of an active investor, then you can add secondary dwellings onto the houses. Once you're into a couple of houses, then I like to move on to a duplex, so 2 units on one site. So this will have 2 rental incomes on one site. That can either be in the metros or in the regions, depending where they're at in terms of the 18-year land cycle. And then once you're into a duplex, then we will finish it off with a block of units, a block of 3, block of 4 as the final trophy piece for your 10 residential foundation portfolio. At this point, you may want to keep going. In residential, you may want to go commercial. You may want to hold up stumps there and let the rent pay off the debt, and then hold the portfolio to be unencumbered and live off the rental income. You may want to sell down the units to reinvest into more properties that are larger assets. You may want to sell down half to buy a family home. You may want to refinance the whole portfolio to buy a family home. My point is, it'll provide you many options. Build the portfolio first. It's like building your chess war piece. It'll be the backbone of your wealth for not just you, but your family for generations to come. And then delay buying the family home, because when you park all your servicing and capital into one site early on, you'll be like 99% of people that get stuck at 1 or 2 properties. Flip the script. Times have changed. This is the best way, I believe, to build your wealth. I started on 400,000 borrowing capacity. Today I'm carrying over 3.5 million in debt. And the only way to do it is by buying properties that are self-sufficient. They pay for themselves. They cash flow 6 to 7% on purchase price. Once you've turned over a tenant, done some cosmetic renovations, freshen them up, then you can push 8, 9, 10% rental yields. Then the banks will continue to lend you more money and you can continue to keep growing. But this is what it looks like. This is the foundation portfolio I can help you build and navigate through the turbulent times ahead. You may be thinking, how the hell do I just go out and casually buy 10 properties in 10 years? You only need to buy the first one. 50 grand, you need to save up, 45, 50 grand, and I can get you going, and that's it. From every property then on after, you'll use the equity release strategy, which is once the property has increased in value, you can order a bank valuation of the property, and then you can reorder a cash out refinance, which is where they increase your loan to the new value and then debit you the difference into your account. So for example, if you bought a property and then you got it revalued at 600,000, but you had a $300,000 loan on that property, if you had the serviceability, you would be able to increase the loan to 80% of the new value, being 480,000. So you increase the loan, and then they will debit you the cash, the 180,000 difference, into your account. So then you can use that cash to then reinvest into your next investment property. And that's it. Every year, make it your goal, make it your routine to buy a property, to do light renovations, to boost the rents. The boosting the rents will then capitalize into a higher price, will then allow the bank to lend you more money against that asset. You can get your deposit money plus more back out. Today, I'm financed into properties 130 to 150%, and they still cash flow. What's that? Infinity in terms of investment. When you've got no money invested, you've got all your money back plus more, and it still cash flows, free property. That's the gravy zone. You want to be in the gravy zone every year, buy a property, do some light cosmetic renovations, refinance it, draw equity, put it into the next property, rinse and repeat. Buy asset, like renovations, put it back on the rental market for higher rent, get an extra 100, 150 bucks rent, push the yield to 7, 8, 9%, go back to the bank with a 12-month lease. I can write you a report run the CoreLogic report for the new valuation of the property at the time. They'll use a combination of comparable sales and the 12-month lease to value your property. You can then draw your equity out plus more to then reinvest into your next asset the following year and do it for the rest of your life. There's no stops to investing. It should be your goal for the rest of your life. Harry Triggerboff, he's 91 years of age. He's still at the helm of the Meriton organisation. They just finished building 2,000 apartments in Parramatta. He is building the biggest projects he has in his life, and he's 91 years of age. So there's no reason to ever stop or ever think, it's too late for property investing. Property investing lasts a lifetime and is intergenerational. Your kids and your family will thank you for not ever stopping investing in property. So that's equity release strategy. These are our key fundamentals. Otherwise, we don't buy it. If they don't tick all these 5 boxes, we do not buy it. Number one, property has to be purchased under the intrinsic value. What's the intrinsic value? In property terms, it is the cost to build. So these days, it costs minimum 550, 600,000 to buy a unit. So we typically pick up units in the metros between 200,000 to 350,000, and it costs between 600 to 900,000 million bucks to build a house. We only like buying houses up to around that 450, 500 grand mark. Once we're hitting around 500, 600 grand, that's when we look at duplexes. Once we're hitting 700, 800, that's when we're looking at multifamily blocks of 3s, blocks of 4 units. So well under the replacement value, being the rebuild cost, well under the intrinsic value, because it's not about what you buy, it's all about the price you pay relative to the intrinsic value. And you can only really find them in the suppressed markets before all the mainstream start piling in. And then when the market starts to pick up, the price you pay will realign to the intrinsic value in a more balanced market. And then when all the stupid money comes in and the FOMO and all the fear of missing out and all the mainstream herd starts rushing in, that's when the price then exceeds the intrinsic value. That's when developers start building like crazy, releasing heaps of stock to the market. Then we go through an oversupply scenario. Then we go through a downturn. Classic property cycle. We go through periods of all property assets getting soaked up now, where there's a restriction of property that then forces yields to increase values, increase yields, then it makes the market stack up, then developers start building more stock, then we go into an oversupply, and then we go through a downturn. So it's about finding the markets that are primed for the next growth run, and it's about finding property for well under the intrinsic value. and under the CoreLogic valuation. So the banks use CoreLogic valuations. We run these reports to make sure that you're getting well under those reports, because that will give you equity on day one. So then you can refinance the loan within 6 to 12 months to go again. Strong cash flow, minimum 5% yield. We don't look at anything less than 5. And typically we pick up properties between 6 to 7% yields on day one. And the only time I'd say is okay to go for something with a 5 in front of it if the rent is not market rate, and I can see opportunity if we can turn over a tenant or boost the rents, do some light cosmetic renovations, then get your 7, 8, 9% rental yield. That's when it makes sense to go with something with a 5 in front of it. But we definitely don't go for anything less than 5, because that's too negative geared. And if you buy something negative geared to save tax, yes, you'll save tax, but the banks will stop lending you money. So that's why most people get stuck at 1 or 2. They go and buy heavily negative geared property and they save 20, 30 grand on their tax, but the banks stop lending them money, and then they're on their hands and knees for the rest of their life paying the difference, the shortfall of that property, and never actually are able to build a large sustainable portfolio. You need to stick to positive geared property. It's like running a business. If you went to the bank and took out $1 million loan and started a business, and after year 1 you had a $50,000 loss, and then you went back to the bank and said, "Hey bank, I just started this business. I made a 50 grand loss. Can I borrow another 500,000 to pump into this business?" They won't do it. It's the same concept with property investment. You have to keep the portfolio neutral to positive geared, so it's washing its own face, to allow the bank to keep lending you more money so you can keep growing and compounding and moving forward. Yes, you'll pay tax. Yes, you'll pay more tax, but that is life. When you earn more money, you pay more tax. And a way around that is by releasing the equity out of the portfolio, and that's when you get the fruits of your labor without being taxed. So 5% yield minimum, growing population. So this is an easy one. All metros are growing in population, they're booming. More so for going regional, we just make sure that they have solid track record of growing populations, because not all regional towns are growing in population. Most are, but not all are. So don't get sucked up in the herd and go and buy a property, for example, in Broken Hill that may have a strong yield of 10, 11, 12%, because the area is in decline in terms of population, and you'll have next to no capital growth. So population has to be growing. That's the key. Point number 4, we like to find suburbs that are yet to go through gentrification. So, and that will experience gentrification. How do you know if a suburb is going to gentrify? Well, gentrification happens to a suburb. Well, firstly, what is gentrification? It is when a suburb transitions from being a lower socioeconomic area, lower class, transitions to a middle upper class. Classic examples, the likes of Balmain, Surrey Hills, Redfern in Sydney, even down St Kilda in Melbourne. These suburbs, great locations, historically very rough, but these days are very bougie and desirable areas to live. They have gentrified over time. That happens when there is initially public investment into an area or a suburb where there has been a lack of historically. So the government will start building new roads, put new metro lines in, new train stations, new hospitals, schools, railways, upgrading the parklands, selling off government housing as they build more urban sprawl and spread out the government housing as they build more suburbs and redeploy. So they'll sell down assets and then reinvest into other suburbs as they continue to grow. When they privatise suburbs that have been historically higher housing commission areas and have lacked the infrastructure, but then they put all the infrastructure in, that then spurs on private development, private investors to come in, buy old sites, knock them down, rebuild into beautiful estates, build new unit complexes. That then converts the whole economy when the new bars and restaurants open up, becomes more activity in the area, draws more capital in from people with more money. That converts the suburb from being an undesirable area, low socioeconomic area, into a very desirable area. So the classic example is Redfern in Sydney, historically very rough suburb. Government spends money on new light rails, infrastructure, schools, sells off housing commission as they redeploy people into other areas as they continue to grow Western Sydney out. And that completely converts Redfern into a very desirable suburb to live in these days, where townhouses or beautiful Victorian homes that were selling for 150 grand, 250 grand in the 90s are now selling for 4 to 5 million today. So the extraordinary growth between that period of time is thanks to gentrification of the suburbs. So we find the equivalents suburbs, blue collar working class suburbs in cracking locations within 20, 30 minutes of the CBD, or right in a solid part of a regional hub, where you can sense that due to the amount of infrastructure going in, that they are primed for growth because they may be close to another suburb or two where there's a complete disparity between price points. There may be houses selling for $2 or $3 million around the corner, where you can buy assets for a fifth of the cost in a suburb that is an up and coming suburb. So we find these diamonds in the rough suburbs that have strong yields. You can buy the properties for well under the intrinsic value, well under the CoreLogic valuations. They're booming in population and they've got all the infrastructure coming in. They're primed for the next growth run for the years ahead. That's our fourth key. Number 5, and one of my favorite ones and the most critical one, is timing based off the 18-year land cycle. So 18-year land cycle, I'm sure if you've been seeing my stuff out there, I can't harp on about this more. So it will make you a fortune and save you from making the wrong mistake. It is an underlying land cycle. It's been happening for the last 200 years in the UK, the US, Australia, and the more global markets as they become more connected. We are in a global market these days. It consists of 14 years of expansion, followed by 4 years of downturn, and the 14 years of expansion is interrupted with the mid-cycle slowdown. The last mid-cycle slowdown we experienced was the COVID recession, and the last land-driven downturn we experienced was the 2008 GFC. So we are now on the blue marker, 18 months to 2 years away from the top of the market in 2026 before we'll then experience the next land-driven downturn. They'll call it something, but you'll know about it come 27, 28. So I use this as a framework to understand where each market sits, because this gives you an understanding of where we sit in terms of the macro market. We sit now equivalent point of time in 2005, mid-late 2005, or 1987. 1 or 2 years away from peak market. So you can use that to look at historical sales data for units, villas, townhouses, houses, blocks of units, commercial, to then understand, okay, how did this asset in this suburb, in this region perform historically from 2005, 6 and onwards? Because is that the right market for me to put my money in today? So you can study history, understand how history, the further back that you look at history, the better picture you'll be able to understand of where we're heading forward. Because historically, Sydney and Melbourne outperformed in the first half of the cycle, like what they did between 2009 all the way up to around 2018. They then topped out. People then decentralised into New South Wales and Victoria regions. They then performed historically in the midsection and did so until 2022. Come 2022, New South Wales, Victoria become too expensive. People then decentralise into the more affordable markets such as Brisbane, Perth, Adelaide, and then their respective regions in the later stages of the cycle where we are now. The market will then top out. The Brisbane, Perth, Adelaide, and the regions will have the largest downturn come the land-driven downturn. Meanwhile, the ripple effect will come back to Sydney and Melbourne, and they'll then lead from 2027 and onwards in the recovery. So we use it as a framework to know when to get into markets and when to stop buying in markets, because we are no longer buying in Brisbane, Perth, Adelaide. Because sure, you may get another 20, 30% growth, but once the market turns, you'll be in negative equity if you keep buying at this later stage of the cycle. But unfortunately, it's what happens in every market. All the stupid money tends to rush in towards the later end of the booms, and they only learn the hard way once the market turns. So we like to get into markets after 7, 8, 9 years of stagnant flat growth, because then it's any time when they then hook through a growth cycle. So that's the key. One, to understand when to enter markets and when to stop buying in markets. I get people asking me, well, should I sell an asset come peak market? Ultimately, I haven't sold anything personally, potentially will, in order to free up serviceability so I can keep buying and reinvesting into larger assets in markets that will have better growth. It's a personal question for yourself whether or not you should sell. Ultimately, time in the market is always better than trying to time the market. But I use this framework to understand which market is best to enter, rather than, okay, trying to use this to work out when to buy and when to sell. That's more of a trading type of investor. I'm more of a long-term hold investor, but I also like to enter markets where I know that they've got pretty much, well, 99% upside and no downside, because once a market has gone stagnant and flat for 5, 6, 7 years, it's pretty well tested. It doesn't go down any further than where it is, especially once the yields start to hit 6, 7%. That's screaming value. Then they're ready for their next growth run. So it's more of an understanding of when to enter markets and when to stop buying into a market. As we were buying in Brisbane between 2018 through to around 2023, but as of 23, late 23, we pulled up stumps in Brisbane and regional Queensland because it just got too crazy and hot. Even though a lot of people are still charging in to Brisbane and regional Queensland because of the Olympic Games and all that stuff. The Olympic Games is great, the infrastructure is great, but really that is just the icing on the cake that gives the final sugar hit to the market. It's not a reason to invest. You need to get in two markets and bake the cake in right from the start of their growth cycle, based off the 18-year land cycle, and enjoy the growth run right from the start, rather than rushing in at the tail end just because we've got the Olympics around the corner. It's not going to give you any substantial growth, and by the time the market turns, you'll lose it all anyway. So that's the framework. And ultimately, building a portfolio is just like building a campfire. You need to start small with a kindling. You then move on to split wood once the coals and the flame and starts to burn and be self-sufficient. You then put a big log on once it's powering and can support that. Same concept goes for property. Most people go to the bank, ask them how much I can borrow, $1 million, $1.5 million, $2 million. They then go and hook themselves to one property and max themselves out for the rest of their time, their life, being a slave to the bank, paying for it for the rest of their life, and never really, hopefully you can hold on to it through the downturns. If you lose your job, then you're stuffed. But that is risky, and that is an unsustainable way to build substantial wealth. You need to start small. If the bank will say they'll lend you $1 million or $2 million, that doesn't necessarily mean you should go and buy one asset with all that capital. You need to spread it out across multiple markets in multiple assets to diversify the markets, but then also diversify government policy. Because right now down in, for example, Victoria, tenancy, the laws down there are very favorable towards the tenants. They've got high taxes, low land tax threshold. That is opportunity. Coming into election, they'll probably, if Labor wants to get re-elected, I'm sure they'll have to rein in those policies. And if a Liberal state government comes in, they'll wipe it, and then the market will be pumping and away at the races again. So every market goes through cycles, not just a property cycle, but also policies that can impact the market. So that's why it's good to diversify across 2 or 3 states at least. And I like to stick to the East Coast. I'm born and bred in Sydney. I like Sydney market, Brisbane market, Melbourne, and the large regional hubs. It's a quick flight to Brisbane, hour flight, and it's pretty much a more diversified and more stable market, similar to Perth. I'd rather buy in Brisbane any day of the week than fly 6 hours to damn Perth, where it's a very heavily dependent on the mining sector. Yes, it's going gangbusters now, but it will switch off and go backwards for 15 years, like what history has shown us. So those are the markets. We like to buy units in the metros as your sacrifice on your yield if you hook yourself to a house in the metros. We then like to go out into the regions when it's a good time, based on the 18-year land cycle, to buy houses. Once they then double, if not triple in value, then if you're looking to get into development, I like to then subdivide to build second houses or build granny flats. Once you're into a couple of houses, then duplexes, then blocks of units. Similar concept to building a campfire. Start small with the kindling, that's the units. Move on to houses, that's split wood. And then once you get in a couple of houses, then you look into multifamily. So duplexes and blocks of units is like throwing logs on the fire and letting it burn all night, being self-sufficient and complementing your lifestyle and supporting you and your family for the rest of your days. Until next time, I hope you enjoyed that. I hope that provides more context into what our strategy is. It's building that solid residential foundation portfolio. Nothing sexy, nothing flash, but fundamental housing. We are in a lucky country. We are on the cusp of really the massive population boom. Big Australia, we are the lucky country. We'll continue to get mass migration with people with money that come here. And the reality is we are in a demand crisis. It's the demand that continues to come into this country that soaks up all stock, puts massive pressure on the housing and housing sector, and the infrastructure and the construction and property industry can never keep up with the demand. It is the best industry, and we are in the luckiest country. We've only got 28 million people, and we've got the world at our feet. If you want help building a portfolio, now's never a better time to start. We've got Sydney and Melbourne at primed for their next growth runs. If you want help entering the markets, hit me up today. I'll put my details in the comments below. As always, this is by no means financial advice. This is just my story. This is how I've developed my own portfolio worth nearly 8 million these days, 17 rentals across 3 states. And I'm on my way. Goal is to hit 100 by the age of 40. If you want to join me on my investment journey as I buy in these same markets throughout the 18-year land cycle framework, hit me up today. Limited spots available. I'm a one-man band with the wife that obviously helps as well, but not looking to build this into a massive organization. I'm looking to create quality portfolios, foundation portfolios for a small pool of clients. I only really need 100 repeat clients who are serious about taking action and building a portfolio. Once I hit that limit, then that might be it. So reach out today if you're serious, get you in the program, get you started. I'm more than just a buyer's agent. I've got a wealth of experience in the construction property industry, and I've developed this blueprint that will help you get to 10 properties within 10 years. Get in touch today. I'll see you on the next one.